For more, though, on the markets, we're joined by Allspring Global Investments Senior Investment Strategist, Brian Jacobsen. Brian, always good to see you, sir. I want to get back to some of that housing news we just read. We're talking about NAHB, 12 straight months of down readings and the lowest number in a decade other than that blip in early COVID. Indicative to you of what?
Yeah, I think that it actually is just reflecting the reality of a recession that the United States is likely to go into in 2023. When I look at a variety of different macro factors, I think that there will probably be an official recession probably around Q2, so end of second quarter of 2023. Arguably, we already had one at the beginning of 2022, so this might be a type of double dip. And it's been bad for housing. You know, housing has been down for, I think it's been more than 8 fiscal quarters in a row as far as on an inflation adjusted basis. Initially, it was due to lack of workers, right? So there was just too much work for them to do, but they couldn't find anybody to do the work. And now we've got higher interest rates and going into a period of time in which not only do you have some of these supply side constraints, but also probably some demand destruction that's likely to take place. So kind of a triple whammy there for housing.
Yeah, certainly housing has been under pressure. Really, the broader market has been under pressure over the last several trading days. The S&P now lower for the 4th day in a row. Brian, is there any chance that maybe we could get a rally into the end of the year? Any good news maybe on the horizon for us?
Yeah, so I'm actually somewhat constructive on the idea that we could get an end-of-year rally with some weakness going into Friday's personal consumption and expenditures data, which is, you know, granted looking backwards. So it's like what were people spending their money on back in November? What was income? I think that we'll see some weakness there. But then also within that report, you get the inflation indicator that the Fed officially is targeting, the PCE price deflator. And that's likely to show some moderation. So if you've got some weak consumer spending, weak income growth, weaker inflation, that might sound like a horrible mixture there, but it actually could be a good thing in the sense that it suggests that the Fed might not need to hike quite as much as what people have originally been fearing for 2023. So that could maybe trigger that Santa Claus rally. And remember, the Santa Claus rally, historically, it starts after Christmas, not beforehand. So I think that we could be setting ourselves up for at least maybe a little bit of a bounce back to end the year.
Hey, Brian, Pras here. Just want to follow up on that commentary about the Fed and rates. Do you think that the doves might see some kind of action here because of the fact that we might see some weaker data coming out of January?
I do. And actually, I think that when I looked at the summary of economic projections that the Federal Reserve released, it was really interesting to see the consensus view for where the Fed funds rate should be at the end of 2023. There were 10 participants that thought that it should be around 5.1% or so. So, right, that's a few more hikes away. There were only a handful that really thought that they needed to go materially higher than that. So those are the most hawkish members. They're also the ones that tend to squawk the loudest. The doves have been a little bit quiet, but I actually think Lael Brainard, as the vice chair of the Fed, I think she's in that little bit more dovish camp. I prefer to think about it as the more prudent camp, to think that we've done a lot already. Let's maybe take a pause and see how things play out. And I suspect that she's actually carrying the majority of the members behind her view here. And it's just a few outliers that are a bit fringe with their views.
Quite a burden to carry there. All right, so the implications, given that setup, the implications and the layout for the bond market.
Well, you know, on my team here at Allspring, on our multi-asset team, we actually have a positive view on the outlook for bonds for 2023. It requires a little bit of pain that we experienced in 2022, but just historically, when we've looked at periods of a recession, what oftentimes happens, you actually get bonds doing pretty well. What happens when the Fed gets closer to their peak for tightness, which I think we're pretty close to there. The end isn't necessarily here, but the end is near for rate hikes. And that actually tends to be a very bullish indicator for the bond market. So here, we're actually pretty optimistic about the outlook for the fixed income markets overall.
And Brian, when it comes to, I guess, what investors should be watching, the biggest stories right now outside of the Fed, of course, there's also earnings. We have FedEx and Nike after the bell tomorrow. But looking further out into 2023, we certainly have already seen some of those estimates come down just a bit. What are you expecting? And I guess in terms of the leadership what are you expecting to kind of lead the next leg higher potentially?
Sure. So I think that we could actually see smaller cap stocks lead the way higher. And not to say that you shouldn't be investing across the capitalization spectrum. Diversification is wonderful. It's in the textbooks for a reason. But as far as tilts in that, I think that actually some of the smaller cap companies could experience a decent rebound, but even more so emerging markets. So when I look at the earnings picture, and I think earnings will be the story for the first part of 2023, expectations for the S&P 500 on the sell side, those are only down maybe 6% from their peak. And so that's not a huge move lower. That's about what we saw in 2015, 2016, where you've seen a massive repricing and almost kind of a wipeout of some of the expectations is in emerging markets. There's basically people are expecting no growth in emerging markets, and those expectations are down about 24% from where they were at the beginning of 2022. So emerging markets, I think, are the ones where you've already seen sort of people just throwing the towel on them. And when people throw in the towel on them, that's where I want to kind of start picking them up.
Brian Jacobsen, thanks so much, man.